Good morning, everybody. I hope you can all hear me clearly. Welcome to the Denker Capital Global Financials call. If you'd said to me a couple of months ago I'd be sitting in my kitchen talking to 81 participants of a call, I wouldn't have believed you, but this is the world we live in today. So this truly is a global call this morning. We have participants from Australia, the UK, Switzerland, and across South Africa. So wherever you are, welcome. I know there are a few more people still logging in. In terms of process and agenda today, I'm going to open up with Cocky in a moment. So I'm going to ask Cocky if he could open up his mute button and his video now. Just to set the scene, Cocky, you there?
Yep, I'm here. Thank you, Nigel.
Okay, morning, Cocky, yeah, I think so. We'll do that, and then we'll hand over. We'll go over to the three members of Cocky's team, the three analysts, Ben, Barry, and Craig, who we're very happy to have on the call today to talk about their respective areas within the global financial sector and to get some comment from those guys. And then Cocky will come back and close out towards the end. Okay. Cocky, would you maybe just give us a bit of background to how you see things right now, obviously the impact of what's happened, previous crisis, and how global financials have recovered out of those crises? Could I maybe ask you to do that to kick off?
Yeah, no, thank you, Nigel, and good morning to everybody. Yeah, I think just going back quickly to when we started in '99, yeah, initially the emphasis of the fund, the Global Financial Fund, when we started it, was always on growth opportunities, but always value and growth. You can imagine thinking back to 97, 98 was the EM crisis, and then in 2000 you had the dot-com crash. So there was an incredible amount of value around. But over the subsequent 21 years that we've been running the fund, we've learned, the importance of strong balance sheets, diversified loan books, the quality of the loan book, capital levels, and I suppose 21 years of listening to Warren Buffett has emphasized the importance of the capital levels. So I think where we are now, the fund has been focusing very much since 2008 on quality and growth. And the search for growth has always meant that in the fund, we've got a large percentage of medium cap financials, because obviously they are smaller, they're more nimble, they are able to grow faster than their slower, bigger competitors. Not always, but those are the ones we search for. And then always emerging markets. Now, why I mention that is that in the current crisis, like each other crisis, those are the ones that always get sold off first, because that's where generally the market has the biggest fear. And especially this market, which has been dominated by fear about financials, we've seen those shares sell off a lot. And so where the opportunity is that we know those companies very well, and that's why we thought it's good to have Ben, Barry, and Craig on the call, so they can work through those and give you an insight into the quality of the franchises the fund is invested in, and that the market, we think, is really wrong in the sense that the market's fear at the moment revolves around really two issues. The one is bad debts. How bad is the cycle going to get? And are we going to see a repeat of 2008, where you'll recall a lot of banks and insurers were forced to do capital raises at the bottom of the cycle when the valuations were at their lowest? And I'll leave it to the guys to explain why we think that is not the case, that the banks that we own, and generally the bank sector, is very well capitalized and very well reserved. And that in fact the digitalization strategies they've been following the last 5 years, 10 years, have really positioned them well. So to my mind, the current situation is what Charlie Munger always refers to as the so-called, in baseball terms, the fat pitch, where as a batter, you can really strike confidently with a lot of power, with very little risk of being caught. And if you look at some of the valuations in terms of JP Morgan trading at book value, and I mean, this is a fortress-like balance sheet, the strongest, one of the best banks in the world, trading at book value. Ben will give you more insight into that. You look at others, ING. ING is trading at 0.33 price to NAV. We'll come back to that right at the end to show you the upsides. And similar, Legal and General, one of the largest and best managed insurers, and it's trading at 1.1 times book. And similarly in emerging markets. So we really think, where valuations have gone, the fears are overdone, and that's why we really arranged this call, so you can hear from the analysts themselves in terms of the detail, so we can present this opportunity to you to really show that the markets are overreacted here. Nigel, I think over to you.
Yeah, thanks, Cookie. I mean, just maybe you can remind, for the benefit of those that don't know the fund and philosophy and process so well, just for a couple of minutes before we turn over to the analysts, just give us a bit of feedback in terms of perhaps process and philosophy, just to remind people, just 1 or 2 bullet points there, if you can.
Yeah, no, thanks, Nigel. I think what is important is that, firstly, I myself have got more than 30 years experience in banking. In the early 80s, I was involved in a few turnarounds, being inside myself, having to turn around financial company and having to go into the clients. And, as you know, when a bank is in trouble, it's got too many clients that have bad debts. And so, I think firstly, we've got immense amount of experience. And that's really what we've used for ourselves, have a very strong matrix of what makes a good financial company. And that's really what the analysts focus on in their research, in terms of finding franchises with good long track records, doing a lot of research, and then we go and visit. We visit the whole time. And all those visits have actually helped us now in we've got a very good understanding of everything. But B, it's also meant that the contact base that's been put in place has made it easy for us to keep in contact now with managements via Zoom and other conference calls. So, Nigel, the philosophy is really we totally index agnostic. We search for opportunities that over time outperform, and we invest in them when they are below value. And the biggest challenge we have now is our arguments are that everything is so mispriced as to, what do we reduce and what do we increase?
Okay, brilliant, Cocky. Thank you. I'll give you a little bit of break now, and we'll come back at the end just to recap. If I can ask Ben, the younger Koyman, if he would just click on his video. Cocky, you can switch your video off. And Ben, are you there? Can you?
Yeah.
Yeah, fantastic. Morning.
Morning.
And Ben, I mean, you cover the developed market banks within the team, and that's your primary focus. I've got a couple of questions here just to help in terms of moving this along. So let's just kick off with that straight away. The capital levels of the banks now relative to 2008 and the global financial crisis. Give us a bit of feedback as to what the difference is in terms of those capital levels today as opposed to back then.
All right. First, I mean, there's a lot of things which go into the capital, but I think one of the main differences now compared to 2008 were some of the activity, especially in the investment banking, which they were doing in 2008 with all their off-balance sheet exposure. Obviously, that's been cut back. So the risk of enormous events destroying a lot of capital is gone, which helps them a lot. Then just in terms of the other regulations we've put in place by the Fed and the ECB in terms of the capital buffers they need to hold, those have been this counter-cyclical buffers, the SIFI, so in terms of the size, I mean, all of those buffers have built up, and at a point we thought it was extreme, but I mean, now we're probably happy that they had went that far ahead, and the stress tests that were done. So, I mean, if you look at, say, just start with the US, in 2007, to use an example of Citigroup, I mean, their Tier 1 ratio was 7.1, it's now 13.3. Which, I mean, it's a huge increase, and that's with the fact that there's now no longer, they can do some of that higher risk lending or higher risk activities. And then JP Morgan's gone from 8.4 to 14%, which also, I mean, if you look at the TCE ratio, which is your tangible capital equity to total assets, it's now the highest it's been since 1940. So I think in that respect, there's a lot of certainty. And I mean, there was a lot of argument at the time, but I mean, the US banks have been thought to be well capitalized for about 2 or 3 years. So, I mean, over the last 2 years, between the buybacks and dividends, their payout ratio has been anything from 80 to 100%. So they actually haven't been building capital with all their profits, and rather been paying it out to shareholders or buying back shares. So the fact that the buybacks have now been stopped, just to, for safety's sake, should also give a lot of certainty and comfort that the capital levels will be built up quite quickly.
Okay.
So dividends can still be paid. If it gets, I mean, when you listen to Jamie Dimon, he said, look, dividends are still fine. And if it gets to an extremely severe scenario, they might cut dividends. But even then, it's rather that the company stays liquid and solvent, and you might miss a dividend, than what, some disaster happens. So it's highly unlikely, especially because all those buffers that they've built up over the years, they can be rolled back. So the counter-cyclical buffer, which means when they go below that, they can't pay dividend, but the Fed and the ECB have said those can be relaxed for this period because obviously, and outside normal environment. So this can be reversed if they need it, and then they can build it back afterwards. But at least there's a lot of solvency and capital left in the system that hasn't even been touched, which they haven't been allowed to access, but now they can access it in a worst case scenario.
Okay. Thank you, Ben.
Yeah,
in terms of, Koki mentions of clients and bad debt provision and everything. Any thoughts around bad debt provision? Have we seen it?
Yeah, the bad debt's a tough one, just because it's based on a lot of right now expectations. So net charge-offs, which is your actual bad debts, basically has stayed the same. So, I mean, JP Morgan took a write-off of 1.4 billion actual charge-offs, which is exactly the same as the year previously. So, but it's all coming to the reserve build now, where they took a 6.8 billion reserve build, and that was mainly in credit card and oil. Those expectations they used was a 25% hit to GDP in Q2 with the recovery thereafter. Now, I mean, that's up in the air. No one knows. So at the time, that was the expectations. They've now moved it to, at the call, of 40%, which means that there could be further reserve builds. But those reserves and assumptions were made without taking into account the interventions from the Fed, like the forbearance, the PPP, the cash to citizens, which all should theoretically lower charge-offs. And even on these huge reserve builds, I mean, they're still profitable. Every US bank came with profitable numbers, except Capital One, which is a credit card mainly focused company. So that took slightly higher, but it should still be profitable for the year. So the reserves could still continue to build up, but going forward, you should see it normalize slightly, or maybe not to the levels previously, but to a much more profitable level. And the thing with reserve buildups as well, I mean, it's a buildup of reserves, but you can eventually, it's not an actual bad debt, so those could be written off. I mean, if we I just looked at Komerční again, which is a bank in Czech Republic. They built up reserves for expectations in 2015, 2016. And then in the next, from Q1 2017 till third quarter 2019, 9 of those 10 quarters actually had net reversals. So, I mean, the loan loss reversal was positive. So it actually was, accounting-wise, income on their balance sheet. So, I mean, in a really bullish case scenario, not only will you have recoveries coming back, you'll have a lot of recoveries coming through, which will artificially but inflate the returns going forward. So there's a lot of positives to potentially building up reserves now. And the better companies will probably build up more reserves, and the weaker companies might not build up as much because of their worry. So it will all come out in the end who's provisioned the best, and that's why we prefer the stronger balance sheets, as they will rather be prudent and reserve more now than later.
Sure. So that's very much your focus is the balance sheet component. Okay.
Yeah.
Income statements and sort of going forward, have you got any thoughts, any sort of additional comments, how you see things playing out in the developed market, banking sector?
Yeah, I mean, it's an interesting one just because obviously the banks have sold down excessively, and across the world, most sectors will be taking strain in terms of the income statement. I mean, shops are closed and, companies aren't doing business.
Sure.
But I mean, if we take out provisions from the income statement, I mean, focus on the main lines, your interest income, your fees, and your expenses. I mean, interest income, it's still earning interest. I mean, the banks, so as long as those people can eventually pay, with all these things will help. I mean, the banks are making on that line exactly the same as they would have. Obviously, the Fed having cut rates will lower the net interest income slightly. But at the same time, the drawdowns in the banks in terms of the demand has been record high. I mean, the loan growth for the companies in the quarter was 5 to 10% on average for the companies, which, if you annualize that, is record numbers. So that helps to stabilize your net interest income. So that, and the Europe actually haven't cut rates. And if you look in Sweden, they've actually increased rates from negative back to normal.
Yeah.
So, I mean, the net interest income, there might be some pressure, but not too bad. It'll just be on the bad debts, which comes from the loan growth. But otherwise, there'll be a lot of strong interest income. Okay. Fees, just a quick one on fees, it's Tango. Obviously, the consumer isn't spending as much, so that hurts them on the fees. But, well, if there's pent-up demand, that could come back quite quickly as soon as the consumer gets out there and starts spending again.
Sure.
But you've got, at America, we saw Bank of America yesterday, the CEO came and said that April's running down 25% year on year, which, I mean, sounds bad, but 25% for the most affected income on the worst month. So that should stabilize quite strongly. And your investment banks actually had record quarters because they said, your equity capital markets might struggle, but then your debt capital markets do well. So you get a bit of a trade-off. So they actually still doing quite well. It should trend down a bit, but not as bad as obviously people expect. So that's another strong no risk area. And then on OpEx, the banks are being in that way, helping everyone out. So they haven't let any employees go. So unfortunately, they won't save much on the OpEx line, although they've all cut back a bit, but that's probably just on growth, curtailing it a bit and, stepping back from projects. So OpEx will be down, which will help them a bit as well. Not significantly, but I mean, all in all, I think that means you've got maybe a 5% cut to your income statement, excluding the bad debts, obviously, in a terrible environment where the market's selling it down 40 to 50% at the moment. So.
Yeah. Okay. All right, Ben. Thank you. That's taken us through to sort of 20 past now. So your focus really around doing analysis on balance sheets, looking for those stronger businesses, aligning that with the valuations that you see that are attractive, and then making a case to the team for those sorts of businesses to be added into the portfolio. I think that's right. So great. Thank you, Ben.
Yeah.
You can click off your video now and rest easy there. We'll pass over to Barry. Barry, if you could come and join us so we can all see you as Barry. And
I'm in. You should be seeing me.
There we go. Yeah. Morning, Barry.
Morning.
I think, Barry, you look after developed market insurers, and I know you're involved a little bit in the emerging markets side of the fund as well. So we can get into that perhaps towards the end. My first question is I think I'm right in saying there's a 23% exposure to the insurance sector in the fund. How's this sector been affected? Will they have to pay claims related to losses? How do you see things? I'm going to ask you just to tilt your screen a little bit down because we can only see the top half of your. There we go. Got a lockdown beard going there. Good man. If you can give us a little bit of feedback there, Barry, that'd be great.
Sure. Thanks, Nigel. Yeah, as you say, the fund is invested at about 23% in insurance companies globally, but it's worth noting that about 2/3 of that is invested in US non-life businesses. And that's because over the years, that's where we've sort of seen the strongest and most favorable fundamentals, as well as where we rate management the most. We tend to like the sector for its defensive characteristics. It tends to be less tied to the economic cycle than most financial businesses. And for our coverage, we estimate like 60 to 70% of book value growth comes from underwriting profits, which is reliant on the underwriting cycle and not the economic cycle. They tend to follow different, or they tend to be much less related. So the sector is certainly going to be affected by the downturn and by COVID-19 on both the asset and the liability side, so claims as well as assets. And that's been reflected. You'll see the MSCI insurance index is down 27% year to date, and the S&P non-life sector is down 18% year to date. As I said, on the asset side, you'll see, well, interest rates have fallen, so it's certain that's affected the asset portfolios of the businesses, as well as the earning potential from those invested assets, which is largely highly liquid government bond type investments. On the claims side, it is likely this is going to be a meaningful event. So we've seen some commentators say that there could be claims north of $50 billion, which would make it larger than Katrina a few years back. But as you can understand, it's still very much an ongoing event, so that is subject to a lot of revision. So however, having said that, the lines that will be affected primarily will be things like travel insurance, surety, trade credit, to name a few. Sure. And for our business, for our fund and for our investments, those lines of business make up a relatively small proportion of our company's books of business. There will probably be some knock-on effects on the reinsurance sector, as those businesses tend to follow the fortunes of those they reinsure. But yeah, by now, sort of at the moment, the biggest overhang we see on the sector is the commentary around business interruption claims, primarily out of the US, where we are seeing that lawmakers are trying to enforce payment of claims for risks not initially covered by contract. So making insurers retroactively pay for losses related to business interruption as a result of this pandemic, where since early 2000s, insurers have explicitly excluded pandemic risk from business interruption, given that the losses could be infinite. I mean, this could go on for much, much longer, and it would just, the industry doesn't have the capital to cover those losses. So we think that the risk of this happening is very low because, and as we've seen in recent weeks, a lot of the companies have come out saying it's simply unconstitutional to do this, which we agree with. So we think the probability is low that this happens, but for now and until we get some more clarity, it's certainly the biggest overhang. In terms of the industry or our holdings capitalization, we think it's very strong. Chubb is a meaningful position in the fund. We had the earnings call last week where CEO noted, despite the expectations of a large industry loss, they believe it will be an earnings event for the business and not a capital event. So echoing what Corky and Ben were saying earlier, for sure we'll see an impact on earnings, 12 to 18 months, but then we think that the fundamentals going forward look good.
Okay.
Yeah. So despite those risks, again, I think just to reiterate, I think our fund's exposure is manageable, and the operating environment in terms of the underwriting cycle looks very attractive going forward. The sector is trading at a 25% discount to its 20-year average. That's globally. In the US, it's a little bit lower. It's about a 15% discount. But this is ignoring probably the most favorable underwriting dynamics we've seen in a long time. So yeah, we're seeing within that there's wide dispersion, and we're definitely seeing some attractive opportunities.
Okay, very thanks. That's quite a good top line overview of how you see that component of the sector. Just in terms of one of the main holdings in the fund, in terms of Essent Group, why don't you maybe just for the benefit of the audience, just take 2 minutes just to unpack the investment case and what gives you confidence of that holding. I think it's a good example, in terms of everybody understanding how you would look at a business. So it talks to the wider process and everything. So maybe just give us 2 minutes on Essent Group, if you could, please.
For sure. So this, as you say, this definitely fits the bill of what Corky was saying as well earlier, in that it's a smaller, more innovative business. It's a market cap of 2.4 billion listed in the US, and the company provides mortgage insurance to lenders to protect them against mortgage defaults. So we made our initial investment in the middle of 2016. Since then, the company's performed really well. It has a long-term track record of underwriting, expense management, and book value growth that is exceptional, which is what initially attracted us to the business. The management owns significant portions of the company, which we like. We like to invest alongside management, and it's, as I said, it's been a good investment up to now. What's happened now is that the stock has sold off aggressively. I think it's down about 45% year to date. And that is around concerns over rising unemployment and with that mortgage defaults in the US. The sector was decimated in 2008, and essentially half the businesses either went out of business or went into runoff. So the market's certainly fearing a sort of Groundhog Day as it relates to this sector, in that, okay, here we go again, capital decimated, going out of business. What I think is easily overlooked is that the market has evolved significantly since then. Essent, by the way, was formed in the wake of the crisis. So it has no legacy exposure on its book of business, and it has a management who worked for one of the incumbents at the time, foresaw the crisis, warned them, didn't listen to him, lost his job, and then subsequently got founders to form Essent. So that's just an interesting bit of history. But as I was saying, the industry has evolved significantly. So what makes it very different to 2008 is that the use of reinsurance was basically non-existent back then, where now, and Essent leads the way in this, and they were sort of a thought leader on this. Majority of the book has some form of reinsurance on it. Secondly, the quality of risk underwritten are a lot higher than they were back then. And that, I mean, there's various measures, but in terms of FICO scores and as well as bank lending standards have been a lot stricter. And excess capital. Essent leads by far the peer group in terms of excess capital with 134% above regulatory minimums. So yeah, it's certain that claims will go up as unemployment rises in the US, but we think that longer term, well, firstly, we think that it's manageable for Essent. Also, most likely an earnings event. We've stressed that in our models. We've spoken to management about it. We've triangulated that with Moody's CCAR stress tests on the business. And yeah, we think it's manageable. And then we think, looking further out, there are attractive fundamentals in the US housing market, with a lack of supply as well as a large swath of the population coming to their peak home buying years. And I think lower interest rates are most likely just going to spur that on if we look further out.
Okay. Thank you, Barry. I'm gonna ask Craig to join the two of us now, because Craig's focus is very much on emerging markets. But Barry, I know that you get involved also in the LATAM side of things. So Craig, if you can maybe unmute and click on your video and come and join the two of us here visually.
Good morning.
Morning, Craig. Guys, just give us, Craig, maybe you just start off here in terms of the emerging market exposure in the fund. Which sectors, which markets are you really focusing upon, and which excite you the most? And then Barry, we can come back and maybe talk a bit about LATAM in a second. So, Craig.
Yeah, thanks, Nigel, and good morning to everybody else. The fund currently has around 25% emerging market exposure. It's predominantly in Asia, emerging markets. There is some in Central and Eastern Europe. Those are my coverage areas. And then there's some LATAM exposure, which Barry covers. Before dealing with the LATAM coverage, I think just to highlight why we're so excited about Asian emerging markets in particular is that the last decade or so has been growth has been fueled by the Asian story, and we think that will continue for some time. Roughly 50% of the world's population currently lives in Asia, and the UN estimates that around 50% of the world's middle income population will be living in Asia this year, and perhaps that might be delayed 1 year out given the coronavirus epidemic, the pandemic at the moment. 50% of global GDP is produced in Asia, and this has increased from 33% in 2000 and is expected to increase to around 60% in 2030. We know that China and India have been significant drivers of this growth, but there are some really exciting smaller economies that are driving the growth beyond this. Places like Vietnam, Bangladesh, Kazakhstan stand out, and a lot of this growth is being facilitated by the financial sector itself. These markets are generally characterized by very favorable demographic characteristics. The populations are extremely large by global standards. They are young, they are growing rapidly, and penetration levels are extremely low. So if you look at smartphone penetration in a place like India, for example, it's roughly 45%. It's expected to double in the next 4 years. And we think this is a big reason why Facebook entered the market there with their 10% stake in Reliance Jio, one of India's largest mobile carriers there. From a credit point of view, private sector credit to GDP is below 50% in countries like India, Indonesia, and the Philippines. And this compares to developed market peers like the US, the UK, and Japan, which are well above 150%. So we see significant growth runway there. And then finally, something say more specific, like mortgage penetration is estimated to only be 11% in India. And this compares to 50% in the US and 91% in the Netherlands. And housing for all is a government imperative in countries like this. Many of them focus their efforts in ensuring housing for all, and we think that they're very favorable tailwinds to this growth story in these markets. Sure. Many of the countries are very strong fiscally. They have low debt to GDP ratios. The foreign currency portion of this debt is extremely low. And a number of them are net oil importers. So they should have an extra benefit given the happenings in the oil market at the moment. Sure. So all in all, we are quite excited about Asian emerging markets. And we think the banking sector or the financial sector is directly exposed to these exciting growth opportunities because they provide the necessary capital and funding to grease the wheels of the economy, if you want to refer to it in that sense.
All right, great. That's a great synopsis. Barry, just in terms of LATAM, just adding on to that, would you agree with what Craig's saying there? Got any further comments about that particular region of the world?
Yeah, certainly. Look, I think we are a little less excited about LATAM as we are in the East, but there are still some attractive opportunities. The fund's exposure is low. It's at about 3%, about 2/3 in Mexico and the rest in Peru. The region has borne the brunt of the pandemic and the pain. So LATAM financials are down on average 46% year to date, with the dispersion very wide. Some stocks down 70% in dollars. And as you would imagine, the currencies have taken a knock as well, with a lot of the countries being commodity exporters, as well as having less favorable debt dynamics than maybe the East, as Craig mentioned. So from a top-down perspective, things look challenging there. And we've seen varying responses in terms of government responses to the pandemic, where you've had Brazil and Mexico initially be very dismissive, where the Andean region acted swiftly. And what we've seen since then is as you can imagine, a vast difference in outcomes. We also think testing is much lower than is expected or as would like to be in the region. So cases are most likely a lot higher. From a bottom-up perspective, the valuations are on their knees. So the Mexican banks are trading well below book value, and this is for a country that has very attractive penetration argument, also as Craig was mentioning, but also a consolidated and rational banking system. The banks there tend to have much higher pre-provision profitability buffers. So I think that puts them in a good position to manage the bad debts that will be coming. Capital ratios are strong, and again, we've stuck with a few companies that have good asset quality track records, where management are significant investors in the business. So we think that despite some pressure, we think manageable. And we've spent our time stress testing, phoning management over the last few weeks, and the jury's still out on how bad it gets. And I think that applies to all of our holdings. But we're confident in our businesses, and also reflective of the challenges is the position sizing. So should we get more constructive, we could probably take it up, given the attractiveness of the valuations.
Okay. Thanks, Barry. Craig, just going back to you, just finally, before we go back to Cocky, just give us 1 minute on if you could pick out one, maybe two companies in the emerging markets segment that you know really are looking at the moment and very positive about? Just give us a couple of names here, just to whet everyone's appetite and what they might see in the portfolio going forward.
Sure. Koki's touched a bit on the way EM currencies and valuations have sold off, something Barry's referred to as well. Sure. Perhaps I'll just add a couple of findings there. And one of that is just in terms of some JP Morgan research that we've seen, that earnings revisions have been much lower, the downgrades and earnings revisions have been much lower for Asia relative to the rest of the world. And but the emerging market outflows have dwarfed this, if you want to refer to it in that sense. Cyclically adjusted PE ratios for emerging markets have only been cheaper 3% of the time. So there really does seem to be a dislocation in valuations from comparing emerging markets in Asia to the rest of the world. So it really does make us excited. A sample of banks that we do cover shows a significant improvement in capital levels since 2008. Which is essentially the inverse of the bank's leverage. So this points to much safer balance sheets. They've increased from around 10% in 2008 to 14% now in 2019. And one of the banks that stands out for us in this regard is HDFC Bank in India. It's one of the leading banks in India. It's a private bank. It's diversified. It has a strong digital presence. We've seen significant growth leading up to the coronavirus pandemic, particularly in its corporate book as they drew down on credit lines to tide them over during the period. Sure. It has generated consistent growth of around 20% in earnings per share and book value over the last 20 years. So it really stands out as a quality, well-managed bank, extremely well capitalized and well provisioned given the current environment. Sure. And we've stress tested the balance sheet, given that it does have some unsecured and SME exposure, as do all the banks in India. I mean, it's significantly increased its market share, particularly because of the organic growth opportunity, as well as the fact that there's a number of lazy public sector or government-owned banks in India, and we expect this growth or the runway for this growth to remain and continue. You know, if as a base case, assuming that the cost of risk increases to the same level seen in the global financial crisis, which is its highest ever, it still manages to produce a double-digit ROE, and we see no risk of any capital raise. One would have to see some kind of extreme event of perhaps a write-off of an excess of 5% of the loan book before a capital raise becomes necessary. So we're quite confident in the bank's ability. Yet it trades at a 26% discount to its long-term average price to book multiple.
Sure.
So Barry touched on the top-down view in that emerging market currencies are generally sold off. The US dollar strengthens in these risk-off environments, and obviously commodity prices are also they're negatively affected by the lower commodity prices. So from a top-down view, things do look attractive. But if in sticking to our philosophy of analyzing things fundamentally and looking bottom up, we think that there really are some very attractive opportunities in Asian emerging markets in particular, given the favorable tailwinds from penetration point of view and the growth that these banks have experienced in the past. And HDFC Bank is one that stands out. And there are a number of other examples which we would happily share after the call if necessary.
Yeah, okay.
Thanks.
Great, thank you, sir. That's fantastic. Koki, I'm going to call you back now. If you wouldn't mind just unmuting and coming back to us via video. Here we go. Koki, I think you've got a bit of a problem here because you've got a strong team of analysts who are knocking on your door with lots of ideas all the time, and your challenge is, putting it all together. Tell us a bit about those challenges and the opportunity. And I'm going to ask you the million-dollar question here, because I know if I ask you, should you invest in your fund, you're going to say yes. But what I want you to do is give us some clarity around what you sort of think the return profile might be for the investors or people thinking about investing who are on the line. What do the numbers look like? So we've got about 5 minutes to go.
Yeah. Okay, Nigel, no, thanks. I think the most important thing is that the discount of the financial sector to the general market is the widest ever. That shows that the financial sector, I suppose, along with oil and travel and leisure, are the sectors that are the epicenter of fear Yet all our research, and you've heard the analyst and all our interactions with management shows that very few banks will actually generate a loss in 2020 or 2021. So, and then as Howard Marks says, discount or fear and uncertainty at the point share prices fall so much that there is no uncertainty anymore because the valuation make up for it. And I think we are there now. If I think back to 2002, 2003, that was post the 97, 98 crisis, the 2000.com. Interesting. I had a young team then, including Neville Chester and Gavin Wood. And after those bad years, the fund went up 70% and 36 and 36. Similarly, if we think back to 2008, in 2009, the fund did 90+% in 2009 and again 36 in 2010. And the valuations now are actually more attractive than they were at the end of 2008. I mean, and I'll just stand with two quick examples. The one is JP Morgan. Simply I use it as an example because it is, the safest, the biggest, the best, excellent management team, unbelievable in terms of what Jamie Dimon has done there, and it's trading at below book value. Then you've got something like ING, which really are the forefront in Europe on digitalization strategies, but it's trading at 0.33 price to book, a 67% discount to tangible net asset value. So to give you some idea, ING prior to the crisis was on its way to achieving a 10% ROE, return on capital. Post the crisis, sure, the world will be slightly different initially. We don't know how long, but even if we have an 8% or a 7% return on capital in 2021, and thereafter it starts normalizing, you're still looking at a price to book of 0.33, which should go to 0.66 at least. So you're talking a doubling. I saw Doc Dani is on the call as well. Dani, jy sal hiervan hou. Ek weet jy hou van dividende en jy vertel vir jou kleinkinders van die dividende. ING going forward is on a dividend yield of 12-13%, similar to ABN AMRO. The dividends have been suspended. They have not been. So next year we will get those dividends again. And so, Nigel, to sum up, valuations are extremely attractive. They are better than they were at the end of 2008, and in 2009-10 we had a doubling in 15 months. I think it could quite easily happen again.
Okay, Koki, thank you, sir. I think we'll leave it there. We're almost up to our 45 minutes. Ladies and gentlemen, I hope that's been of value to you. I think it's important for you to meet other members of the team. Many of you will know Koki well, but it's great for you to hear from Craig, Barry, and Ben. If you've got any follow-up questions or anything, please email me on the invitation. My email should be there. This call will be recorded, has been recorded, and will be there'll be a link on the website, and we'll send out a few follow-up notes as well. But guys, thank you for your input. There certainly seems a strong opportunity. I know you're very passionate about this sector, Koki and the team, and looking for strong businesses at the right valuations and building a really robust portfolio for the future. So thanks again. Stay safe, everyone, and look forward to inviting you and having you on another call in the future. Okay, that's it for now. Okay,
thank you.
Bye for now.